Hey guys, welcome to my channel. I'm your investment partner Josh. Let's start with the basics. There's two questions I want to answer in this video. Are we headed to a market crash like an all-out war, or are we headed to a market correction maybe? 10, 20, 30%, or maybe nothing ain't about to happen. Which one of these options actually happens? Now I can't predict the future. I'm not an oracle. I've actually compiled the list of 5 things I'm going to be looking at to determine whether we're headed to a market crash or a market correction. So the first thing is inflation rate. The second thing is the Delta variant or any other variants out there that may or may not yet exist versus the reopening. The third one is what's going on with the real estate market, because there's an overlooked area that will impact the stock market a lot. Remember 2008, now China stocks or the entire Chinese government and regulation is another thing I'm going to be looking at. The hypertantrum, one of the biggest fears right now in the market. I'll explain what it is and what I think the probability of it happening, because that might lead to a crazy market. And also stock market valuations. Are we in the bubbles, or is this just the cost of being disruptive like Casey Wood says? I'm gonna analyze all 6 of these and I'll give you my answer at the end. So let's start with inflation, the first factor. I'll explain why inflation plays a major role in this move. Now you would agree with me that most of you understand inflation. You can explain what inflation is. You're getting the same amount of dollars, but your dollar buys you more effectively in a time of less inflation. In a time of more inflation, your dollar buys you less. Quite simple. But how does this have to do with the stock market crashing? Well, it does. Let me explain. Once the train leaves the station, you have a very limited amount of time to catch it before it turns into a runaway train and turns into a hyperinflation, which is something a lot of people are afraid of. Now, the guy who's supposed to catch the train before it goes berserk and stop it is Federal Reserve. They're the ones responsible to pay attention and stop it. Now, they're actually playing a very dangerous game right now. They're trying to restart economy. They're trying to push it forward because of the pandemic effects. But they don't want to push it too hard, so they lose control over that train. That control is basically the tapering issue. Now, inflation has to be controlled by the Fed. How would the Fed control inflation? The Fed controls inflation by raising or reducing interest rates. Now, if the interest rate goes up, people save more money, they spend less, and obviously you have a lot less available income to spend on nonsense. That way you kind of slow down inflation. That's a very basic explanation. Now, obviously the Fed doesn't have a dial which they can use to, like more interest, less interest. And that's exactly what the Fed has been doing for the past few months. They are buying a lot of bonds to keep money in the stock market, to keep feeding the system with cash, with liquidity. When you're buying bonds, the Fed creates demand for a bond, which lowers the actual yield. Now the yield lowers and everybody chases the yield elsewhere, and elsewhere is the stock market, pushing the stock market upwards. Now imagine this situation. Imagine that now the Fed lowers the amount of asset they purchase every month. Now they're spending about $120 billion per month. Imagine they slash it by half. Demand goes significantly down, yield goes up. If that happens, people will be chasing more yield in the bond market, essentially driving away demand from the stock market to the bond market, creating less demand for stock, reducing the price. Now that's the big fear. So here's the thing. If you have the situation where Fed eases basically the foot and they don't press on the gas, they're basically trying to slow down the inflation by actually increasing interest rates. What might happen is what a lot of people define as a taper tantrum. If the market thinks that the Fed will do it, it can create a self-fulfilling prophecy of cluster of mess. I think in September they'll come out and they say we are actually thinking about doing this by the end of this year with actual operational guidance. As to when this is going to happen, I think September is where they're going to push the trigger if they want to get it down by the end of this year. Because unless you think inflation is completely transitory, unless you think that it has nothing to do with the reality and just a supply chain management issue that'll go away, you have to do something about it. Despite John Paul coming out and saying, well, it's transitory, clearly that's what the Fed thinks, because everybody in the Fed right now talking a whole different language where they need to slow down asset purchases, which means they don't believe this is a transitory inflation environment. It is what it is. However, there's an X factor here that you need to understand. This whole thing may not even happen, because one thing that may slow down this whole process and throw a monkey wrench into this reopening case, inflation. Because inflation is growth, reopening equals inflation pretty much in this equation. If we have the Delta variant go crazy or any other variants, even every week we have new variants. If certain variants go crazy and halt reopening, bring us backwards into this lockdown situation, if that happens, the Fed is going to have way more leeway to buy more bonds, more assets. Because it's going to slow down the whole reopening inflation situation, which will allow a much softer landing. So that thing kind of counterintuitively, the Delta variant or the pandemic coming back, or whatever the lockdowns might actually prevent a stock market crash, as crazy as this sounds, because it will allow the Fed to keep buying up bonds and actually increasing demands and reducing yields, pumping up the stock market. I know that sounds crazy, but we live in a crazy world, and having said all that, here's my opinion. I look at other factors as well. For example, I see the Bitcoin rate goes up almost 50,000. That's actually an indicator that people looking at the safe haven to park their money away from the stock market. That's an important indicator. Also, Michael Burry is betting heavy on inflation. Not saying that Michael Burry is a god or an oracle, but I mean, that's another dude that kind of knows what he's doing, talking the same language, and most importantly, it came out that Microsoft is now at 300, which is insane. I think it might hit 220 by end of this year, but it just hit $300. Now, this happened with a bunch of companies this month and last month. At certain points, I think I gave certain companies 90% growth for the next 5 years. It still comes up as a price right now being way overvalued or right on point. Nothing is cheap anymore. The stock market is showing me that the overvaluation, the stock market is definitely bubblish. Now, I'm not saying we're in a bubble. I'm just saying that the price right now can't be justified long term. Given the price, given the earnings, given the growth, this will have to be a crazy 5 year to justify current prices. And just to be clear, I don't think the stock market is in a bubble at all. I just think it's a little bit more overvalued compared to the fundamentals. And there's one thing you need to know is over the course of time, it always evens out. It's like a 3-point shooter. If you have a 20% shot from 3 and you had a great night, eventually the more games you play, it evens out towards the 20%. That's why prices are bound to correct backwards, because right now valuations are out of control. Microsoft is just one example. So how do I deal with this? Quite simple. I consolidate into value plays and my highest conviction stocks. I want to have stuff that are low P, high revenue, no capex, very simple, and as well as tech plays, as well as speculative tech plays. That's that I'm absolutely in love with, which I don't care about the price. Like for example, like Tesla. There's a lot of other examples. It's completely individual. This is just my opinion. Again, might be inaccurate, might be wrong. out of the video, leave a thumbs up, leave it in the comment section below. Let me know which one of the stocks you're trading. We'll see you in the next one. Thanks for watching.